ConocoPhillips recently announced earnings for the second quarter of 2023. The stock is up 6% while the rest of the market is up 8%, so they're underperforming the market slightly. And in this video, I'm going to look into some of the recent news that came out surrounding Conoco. I'm going to look into their financial statements, and then I'm going to use a discounted cash flow model and figure out Conoco's weighted average cost of capital to figure out the intrinsic value per share for the company. So right here in this article, it's titled Profit. ConocoPhillips misses earnings expectations despite record production, and it shows that profits were sharply reduced from the year-ago quarter when surging oil prices buoyed revenues. We can see they point out energy giant Conoco posted second quarter profit revenues that missed expectations, reflecting a pullback in oil prices from last year's highs and despite record production levels. Their revenue fell 41% to $12.8 billion, well below the consensus estimates of $14.7 billion. And we can see that the CEO pointed out in their earnings announcement that they continue to enhance their deep, durable, and diversified asset base, and they are currently well positioned to generate competitive cash flow and returns for decades to come. Lastly, right here, they point out that among their latest projects, Conoco finalized an acquisition of an equity stake in Qatar's North Field South oil field, and they signed a 2-decade offtake agreement with Mexico's Saguaro export facility, which specializes in shipping liquefied natural gas, LNG, and under the agreement, Conoco will buy up to 2.2 million tons of LNG annually from the facility. So they're trying to make moves to contribute to their revenue and earnings increase. Obviously, the energy sector is very cyclical, so Conoco has seen a decrease in revenue and earnings, much like many of the other oil companies that we've looked at in the second quarter. So right here, these are their financial statements. We can see that revenue decreased from $21.9 billion to $12.8 billion, down 41.4%, and net income decreased from $5.1 billion to $2.2 billion, down 56.6%. So not a very good quarter for year-over-year results for Conoco. For balance sheet, we can see they have total assets of $89 billion, and then we can also see total liabilities of $42 billion and total equity of $47 billion, with retained earnings of $55 billion. Then lastly, on page 7, for the first half of 2022 compared to 2023, operating cash flow decreased from $12.9 billion to $9.2 billion, and they used cash flow of $6 billion in their financing activities. They paid out dividends of $2.8 billion, up from $1.8 billion, so that's a pretty massive increase in dividends paid out for the first half of 2023 compared to 2022. And then they also repurchased common stock of $3 billion, down from $3.7 billion last year. So they repurchased less common stock this year and paid out more dividends this year to shareholders. Right here, this is the discounted cash flow model. I'm using a growth rate of 24%. I got that from their historic growth rates for their free cash flows. In 2018, they had $6 billion of free cash flow, and in 2022, they had $18 billion. Compounded annual growth rate over 5 years comes out to 24.06%. For weighted average cost of capital, that came out to 7%. We can see right here, I calculated their cost of equity using their book value of equity and debt, which comes out to $48 billion and $45 billion. Interest rate on their debt in 2022 was 3.6%. Their effective tax rate was 33%. 10-year treasury yield right now is 4.2%. They're a little bit more volatile than the rest of the market with a beta of 1.3. And so that puts their cost of equity at 11.84%. That's just the risk-free return plus the company's beta multiplied by the average market return minus the risk-free return. Their balance sheet is made up of 51% of equity, 49% of debt. So to calculate their WACC, I multiplied the equity proportion by the cost of equity, added that to the debt proportion multiplied by the cost of debt, and then multiplied the debt proportion by the tax shield, which is just 1 minus their tax rate. That gave me the weighted average cost of capital of 7.22%, which I used to calculate the discount rate to discount their future cash flows to the present value. Free cash flow for the most recent full year, $18.16 billion. Net debt position of $9 billion and 1 billion shares outstanding puts their intrinsic value per share at $543 per share, meaning that at the current share price, they would definitely be trading below intrinsic value per share. But keep in mind, in order to be trading below intrinsic value per share, they have to grow at 24% compounded annually for the next 5 years. just like they did for the last 5 years. And given that the energy sector is very cyclical, it's very challenging to figure out if they'll actually be able to grow at the same rate that they have been historically. Right here we can see, comparing them to ExxonMobil and Occidental Petroleum, they have better profit margins than the other companies besides gross profit margin and net profit margin, which go to Occidental Petroleum. But so yeah, actually they come in second place ahead of Exxon, but behind OXY. Return on equity is 39%, middle of the pack once again. They have a 0.36 debt to equity ratio. They have a PE ratio of 11 times earnings, and they pay the highest dividend yield of 4.23%. So for every $100 you invest into Conoco, you're getting paid $4.23 per year, which is an extremely good return just in terms of dividend yield. That basically means that you're going to get a 4.23% return on your investment per year if the stock price basically just stayed flat. So that's a pretty good return just for dividend yield. It's a pretty high dividend paying stock compared to Exxon and Occidental Petroleum. So based on this, obviously for dividend yield, you want to give it to Conoco, but for profit margins, it looks like you probably want to give it to Occidental Petroleum. Lastly, compared to other companies we've looked at, it looks like ConocoPhillips is trading at a pretty competitive share price compared to intrinsic value per share. Currently trading at 22% of their intrinsic value per share. Right now, OXY, Exxon, AMD, Chevron, Google, Alibaba, Albertsons, and Etsy are the other companies we've looked at that are trading below intrinsic value. For growth rate, they had an estimated growth rate of 24.06%, good enough to get them into 10th place on the table. AMD had the highest at 83%. Gross profit margin and net profit margin, ConocoPhillips had a 23% net profit margin, so that's good enough to get them onto the table. One of their main competitors, Oxy, holds the first place spot at 36%. But for gross profit margin, they only had a gross profit margin of 37%, so that's not good enough to get them onto that table. Adobe has the highest at 86%. For dividend yield, Conoco had a 4.23% dividend yield. That's very competitive compared to the other companies we've looked at, puts them in third place. But for a second quarter year-over-year revenue and earnings growth, they had revenue decline of 41% and earnings decline of 56%, so not good enough to get them onto these tables. Revenue for Tesla increase was 47%, and then for Intel, the best was 400% Q2 earnings growth. And lastly, for stock performance over the last 5 years, Conoco increased 65%, which is not good enough to get them onto the 5-year chart. It looks like Tesla comes in first place with a 1,144% return. So based on this, Conoco is pretty competitive in terms of profitability, dividend especially, and then also for share price to intrinsic value, but they aren't good enough to make it onto any of the other tables. They're very competitive in their industry. They pay a very high dividend yield compared to Exxon and Oxy, and based on this discounted cash flow model, they're currently trading below intrinsic value per share. So let me know in the comment section down below what you guys think of Conoco. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.